Hello and welcome. In this video, we will learn what OFS and FPO are. Alright. Now before we do that, I want to tell you about the requirements for an IPO in India. Okay. So the company, if it wants to go for an IPO, then it must have existed for at least 3 years. Okay. Only after that it can go for an IPO. Next, it must have made profits in at least 2 years of its existence. Okay. Third is that it must have a minimum net worth of 3 crore rupees. Okay. So these three are the main requirements for going for an IPO in India. Up until now, I have been using the example of a company applying for an IPO before it even starts. But this was just to make the example simple for you to understand. Alright. Remember that there are strict requirements for going for an IPO in India. Okay. Now, let us first learn about OFS, which is offer for sale. Okay. To explain this, I will take the same example that I have been using. Okay. So let me quickly recap the story. Two friends want to start an industry that manufactures coconut oil. The friends who start the company are its promoters, and let us say that the name of the industry is oil. To start the company, they know that they need 10,000 rupees. So person A or promoter A contributes 4,000 rupees for the company, and person B contributes rupees 2,000 for the company. Totally, they have 6,000 rupees. They still need 4,000 rupees more. They go to the bank or they go to a bank, and the bank offers a maximum of 2,000 rupees at a certain interest rate. They take that loan, but they still need another 2,000 rupees. And so they split the company into 4,000 shares of 2 rupees each. Person A and person B keep 2,000 and 1,000 shares for themselves respectively, and the remaining 1,000 shares are offered to the public through an IPO. The public buys the 1,000 shares in the IPO, and the company gets 2,000 rupees that it wants to start the industry. Alright. So this is what we have seen till now. Now let us say that the company starts working, and after some time, due to profits, the value of each share in the market rises to 6 rupees. Okay. Now, the promoters decide to sell their personal shares. Okay. We have two promoters, right? Person A and person B. And they have 2,000 shares and 1,000 shares with them. Right? Now, if they want to sell these shares to the public at a discount, then it is called as an offer for sale or an OFS. Okay. Now, the question, why would promoters want to sell their shares? The company is doing well, correct? The share price has increased from 2 rupees to 6 rupees. So why not hold on to them for a longer duration? Well, there are a few reasons for selling these shares. First is the SEBI regulation. According to SEBI, which is the governing body, promoters cannot hold more than 75% stake in a listed company. So if their stake is higher, they must sell the excess shares through an OFS or offer for sale to comply with the rules. The second reason may be personal reasons. A promoter might need money for a personal reason, like investing in another asset or funding another venture, or he may be needing the money for any of his personal expenses. So, selling his shares or selling their shares is a way to get that cash. And another reason, which is a red flag, is something to watch out for. If a company is in trouble, the promoters are the first to know. And when they know that their company is in trouble, they might try to sell their shares through an OFS to get as much money as they can before the company's value goes down. Okay? If a company is in trouble, first the promoters come to know and later the public comes to know about it. So before the public comes to know about it, the promoters try to sell their shares through an OFS. Okay? So this is a red flag for investors. Alright? So an offer for sale is simply promoters selling their existing stake in the company. The money from an OFS goes to the promoters and not to the company. Alright. Now, let us continue with the same story and learn about follow on public offer. Okay. Over the next 5 years, the company is profitable and each share costs rupees 6. Okay. Now, the promoters want to expand their business. They want to expand their business further. To do this, they need more money, right? So they have two main options now. They can take another loan from the bank. However, this means paying continuous interest and there is a limit to how much they can borrow. The banks will not give as much money as the promoters want, correct? The second option is to offer more shares to the public. When the public buys these new shares, the company gets the money it needs to expand. Right? So this process of a listed company means the one that is already listed on the stock exchange. Okay. So this process of a listed company issuing new shares to the public is called a follow on public offer or an FPO. It is called follow on because the company already had its IPO. Right? So in the IPO, it had offered 1000 shares to the public. Now, if it wants to offer new shares to the public, then it is called as an FPO. Okay. Now, let us say that the company issues 1000 more shares to the public, meaning now 2000 shares are with the public. Okay. When a company issues shares through an FPO, it is creating brand new shares and selling them. The money raised from this sale goes directly to the company. Okay. And since new shares are created, the total number of shares of the company increases. So before it was 4000 shares, now it is 5000 shares. This is an important point for existing investors because creating new shares means their ownership percentage gets slightly smaller, and this is called as dilution. Okay. Now, why does a company issue an FPO? As mentioned, a company issues an FPO if it wants to expand its business or if it needs funds to pay off its loans or debt. Okay. Now, how does an FPO affect us as investors? Let us compare an IPO and an FPO. In an IPO, the company is new to the market. As investors, we do not know how it will perform. So there is more risk involved. Correct? But in an FPO, the company is already listed and has a performance history. So we can see how its business is running. So there is less risk compared to an IPO. Okay. Now, the FPO price will generally be lower than the current market price. That is the price at which the shares are being traded at. Okay. So when the company offers an FPO, it will be offered at a lower rate. This is done to attract the investors. Alright. What does the company want? It wants money. And how do they get money? By selling shares. So the company wants investors to buy their shares in an FPO. So they offer it at a lower price than the market price to attract the investors. Okay. Next, the question you may have in your mind is, should you apply for the FPO? Now, if there is an FPO, you as a retail investor, a common man, should you buy the shares or not? How do you decide? Right? You can decide by answering 3 questions. So let us see those 3 questions with our coconut oil mill example. Okay. The first question is, why is the company going for an FPO? What is it that the company wants to do? Does it want to expand the current business or does it want to go to a new business? That is the question that you need to answer. For example, if you take the coconut oil mill, why does this company go for an FPO? Is it to increase the production of coconut oil itself or is it to do something else? If it is going to increase the capacity of the production of coconut oil, then it is well and good, because currently the coconut oil is being sold and there is a demand and there is a market which is very good. So if they want to produce more coconut oil, then you know that the company will be doing good in the future. So we can think, or you can think of investing. Whereas if the mill wants to do something else, let us take for example, if the mill wants to make olive oil, then it will be risky for the investor, because the investor doesn't know whether olive oil will sell in the market just like coconut oil. In other words, let us say that they expand their business and start producing olive oil. We do not know whether it will be profitable in the long run. We do not know whether there is a market for olive oil. So we do not know what is going to happen with the company. So whether they are doing the same thing, expanding their business, or they are venturing into a different area. That is a question that you need to ask. Okay. Second is, what is the promoter shareholding? How much shares are the promoters holding? Now I talked about offer for sale, correct? In the FPO, are the promoters buying the shares? If yes, then it is a good sign, because promoters are confident that the new venture will be successful, and so promoters are also buying in the FPO. Whereas if you see an OFS in an FPO, that is, if promoters are trying to sell their own shares in an FPO, then it is a bad sign. Okay? Why do the promoters want to sell their own shares in an FPO? What is it they are hiding? Correct? That is a bad sign. So if the promoter shareholding increases or it stays the same, then it is good. But if they are trying to sell their own shares in an FPO, then it is bad. Okay. The third question is, how much is the debt? Debt is nothing but a loan. How much is that? Do they have a lot of loan which needs to be repaid, or are they clearing the loan yearly? If they have a lot of loan, then it is a bad sign. If they have cleared and it is only a small amount remaining, then it is good. Okay. So if you can answer these three questions and if you get positive answers, then you can think of applying for an FPO. Alright. These are the basic guidelines. There are no strict rules for applying for the IPO. Okay. So think well, study about the company and then decide whether to go for an FPO or not. Alright.